All right, survivor benefit plan, SBP versus life insurance. So my man emailed me yesterday or a couple days ago about SBP, which is for military personnel who are retiring. SBP is you buy survivor benefit protection essentially. That way when your spouse survives you, she will get 55% of your pension. And it costs you, I think it's like 300, maybe 350 bucks a month for 30 years or until you're 70, whichever is earlier. Off the top of my head, I can't remember, but it's something along those lines. Used to be, I think it's, we'll just say for simplicity, 350 bucks a month for 30 years. Because most people aren't going to retire from the military when they're 60. Most people are going to retire from the military when they're 40s and early 50s at most. The vast majority of people aren't going to retire when they're 60. But it doesn't matter. That's how SBP works. So if you want to leave your spouse, and again, mostly it's the wife, a portion of your pension from the military, well, hold on. Now I'm all caught up here, boys. You buy survivor benefit, SBP, before you separate from service. All right. So if you had a $50,000 pension, your spouse will get, what's that, $27,500, something like that, at your death. It's just basically it's a 55% survivor benefit. That's all it is. Now, what happens is a lot of people say, well, I can use that $350 a month and buy a life insurance policy. And they'll buy a universal life policy, which is what they'll be sold on. Now, I worked at USA, so I'm very familiar with this strategy. And I'm very uncomfortable with said strategy because a universal life is not whole life. It is a permanent life insurance policy, but it's not whole life. A universal life is contingent on interest rates and the cost of insurance. And the cost of insurance on UL, Universal Life, increases as you get older. Thus, the cost for you to maintain that policy and keep it in force grow every single year because you're getting closer to death. Now, what that means is, if you don't have a large enough cash value in there built up in your UL policy, as you get older, your cash value will start being reduced in order to pay the policy. This is the problem with universal life. If interest rates don't change and the costs go up and you have less value in terms of the cash value, and the cash value is slowly but surely being depleted because the costs are going up and you don't have enough cash to cover the payment, you're going to have a couple things going to happen. 3 things can happen. You're going to have to put more into the policy, either with a lump sum or heavily increasing your premium. The policy will go kaput, all right? It'll expire because there's not enough cash to maintain the policy, or you'll have to reduce your death benefit. One of those 3 things. And trust me, when I was at USA, I cannot tell you how many people bought universal life policies in the 90s thinking the interest rates of the 90s were guaranteed, and then they wake up in the 2000s and 2010s, and all of a sudden they're sitting on a policy that's going to expire in 2 to 3 years. And let me tell you something, having these conversations with a high-ranking ex-military personnel, many of them were doctors and stuff, who are flag officers for retirees, and say, hey, Dr. Smith, you have to dump $80,000 into your universal life policy to keep it active, or what we call in force. And Dr. Smith's like, what? And you say, not only do you have to do it, you got to do it by the year end. They're like, why hasn't anyone made me aware of this? Well, because life insurance companies are not notorious to tell you bad news. Or they'll say, we sent you an email, or something. It's crazy. And then what would happen is you'd get a list of people you had to call to tell them about the life insurance policies that were maturing or going to expire. By the end of the year, you have to call and figure out what they wanted to do. You didn't get that list 5 years previous unless you actually scoped it out, which I did because I was a good financial planner. I'd create my own list, say whose life insurance policies are going bankrupt, or not bankrupt, going to go expiring in the next 5 years. And I'd start calling those people because it'd be less costly to the insured to maintain the policies. And I'd have a lot of good conversations with people. Say, hey, look, man, I had a doctor came to visit me in Center City. Pissed as Asian guy, pissed as can be. He's like, dude, I can't believe I got to come up with $80,000. I said, well, you don't, but you don't have to this year, but you're going to have to, if you wait until year 5. Right now, I just need 40,000, and we can, keep this going for at least another 10 years or so under current interest rates. Now, I guarantee that's probably not the case now because the interest rates went down from we had those discussions. Eesh. Anyway, so if interest rates stay low or flat, universal life policies probably won't last until you're dead, unless you really fund that guy with significant cash value. So that's one drawback about universal life. You sit there and say, I'll put $350. So the money I would spend on my survivor benefit, the $350 a month, instead of having that coming out of my pension, essentially paying the DOD to provide my wife with a 55% benefit that I may or may not need because I might not die before she does, I'll instead buy a life insurance policy. In of itself, that makes sense. If the life insurance policy expires before you do, though, then your wife is left without any survivor benefit protection. So she won't get any of your pension, and she won't get any life insurance. That's not good. I've had many, a colonel, a major, a few flag officers that were dealing with that. We're saying, man, I got to pick up some dog poop. Your survivor benefit, they're running out of money, and they can't get insurance now because they're 77. I'm not running out of money. They're sick. Maybe they have Alzheimer's, whatever, but they're not in good physical shape. And their life insurance expired, and they don't have that much money. I mean, they got a little bit, but their wife is like, I don't have any benefit at all. Nope. Was life insurance, right? No, it expired. What? I can't tell you how many times that happened, man. It's crazy. That's at USAA, not some fly-by-night insurance company. Now, you could change and say, all right, I won't get a universal life policy. I'll get a whole life policy. Well, whole life policies are freaking a hell of a lot more expensive on the front end because they're literally guaranteed, as long as you make the premium payment, to cover your whole life. But how much will $350 a month buy for a guy who's 55 for a whole life policy? Don't forget, they got to underwrite you. And a lot of times the underwriting isn't all that great. You might have issues. You might have high blood pressure. You might have all kinds of things. And so the whole life policy won't buy you a significant death benefit. So now your $350 a month isn't enough to cover that much of a death benefit relative to the 55% survivor benefit. But at least you know for a fact, as long as you make the $350 a month premium payments, your life insurance will be there for literally your whole life. So that's a good thing. But that's a risk there too. So now people say, well, this is what I've had a million times. Well, I'll just buy $500,000 term. It'll cover me till I'm 75 years old. I'll invest the difference. So I'm 55 years old. I'll get a $500,000 term. It'll cover me for the next 20 years. And it'll cost me $150 a month for my term policy. And I'll invest the difference at $200 a month into an S&P 500. And that will take over once the life insurance expires, because the term will go away by the time I'm 77. The amount of money I was able to score away at $200 a month will be significantly higher, most likely, than what the life insurance would have been, or what the survivor benefit would be. And that always, buy term and invest the rest. I don't think that's, people just don't do that. I mean, some people will. I have yet to see that work very often and very successfully, because life happens. Did you really want that $200 a month to go into your life insurance policy? Or, oh man, we got a sudden increase in property tax. Oh man, I got a sudden increase in my my health care costs. Or, oh man, Part B, I didn't realize the premium's going to go so much higher. Or whatever it is. All of a sudden, that $200 a month isn't investing into your S&P 500 index fund, or the funds don't do as well as you anticipated because the markets fluctuates. Anyway, look, if your wife is significantly older than you, then I wouldn't buy the SBP most likely, because she's going to die first. If your wife is going to die first, I probably wouldn't buy the SBP. Ideally, what you do is you fund your life insurance with a significant one-time drop-in, say $50,000 on the front end. The more money you put on the front end, the more cash I was able to grow, tax-free, by the way. And that usually is a better way to sustain your life insurance policies. But what I'm just telling you, man, but 77 years old, Colonel Mills is about to die. He's got $255,000 in his account. His TSP or whatever. His wife is accustomed to living off a significant income. Now she's not going to have much. She'll lose her Social Security and lose the pension. All she's going to get is his Social Security and whatever he's got on his 401k TSP. Oof. Anyway, as a conservative-minded guy, I'd buy the SBP and just be done with it. All right, love your thoughts. We'll see you